Ladies and gentlemen, good day and welcome to the Syrma SGS Technology Limited Q2FY25 earnings conference call hosted by DAM Capital Advisors Limited. As a reminder, all participants' lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Bhumika Nair from DAM Capital Advisors Limited. Thank you, and over to you, ma'am.
Yeah, good morning, everyone. A warm welcome on behalf of DAM Capital to the 2QFY25 earnings call of Syrma SGS Technology Limited. The management will open up with opening initial remarks, post which we'll have a Q&A. At this point, I'll hand over the floor to Nikhil Gupta, Head Investor Relations, to take the proceeding forward. Over to you, Nikhil.
Thank you, Bhumika, and hi, very good morning to all. Welcome to Syrma SGS Q2 and half-year FY25 earnings call. We have with us today Mr. Jasmeet Singh Gujral, Managing Director, Mr. Jayesh Doshi, Director, Mr. Satyendra Singh, Chief Executive Officer, and Mr. Vijay Agrawal, Chief Financial Officer, Syrma SGS, to discuss the performance of the company during the second quarter and half-year 2025, followed by a detailed question and answer session. Kindly note, during this call, certain statements that will be made are forward-looking, which involve several risks, uncertainties, assumptions, and other factors that can cause results to differ materially from those in such forward-looking statements. All forward-looking statements made herein are based on the information presently available to the management, and the company does not undertake to update any forward-looking statements that may be made in the course of this call. In this regard, please do review the disclaimer statements in the earnings release and all other factors that involve a difference. With this, I will now hand over the call to Mr. Jayesh Gujral, Managing Director, Syrma SGS. Thank you.
Hi, ladies and gentlemen. A very warm welcome to the Q2 FY25 earnings call of Syrma SGS Technology Limited. I take this opportunity to wish all of you and your families a very happy and safe and joyous Diwali. I'll in brief delve on the numbers for the Q2 and H1. We achieved a sales revenue of rupees 8356 million, a 17% year-on-year growth. Operating EBITDA of 738 million versus 546 million in Q1 and 504 million in Q2 of FY24, representing a growth of 35% quarter-on-quarter and 46% year-on-year. Operating EBITDA margins for the quarter stood at 8.8% and for the half year at about 6.4%. In Q2, PAT stood at 396 million versus 203 million in Q1 and 305 million in Q2 of FY24, representing a healthy increase of 94% Q-on-Q and 30% year-on-year. The second quarter saw a partial recovery of exports. Exports accounted for 23% of our revenues in Q2 versus 16% in Q1. We expect this momentum to be further strengthened in the second half of the year. Net working capital came down to below 60 days. Vijay will delve with the numbers in detail, and we generated a healthy operating cash flow. Vijay will delve on the numbers. The order book stood at a healthy 4,800 crores with secular breakup between the various verticals. We stand by the full year guidance of 40-45% growth and 310 to 320 crores of EBITDA, which translates into 7%. During the quarter, we commissioned our design center in Pune, dedicated to the medtech business, and the initial response from the customers from Europe, Japan, and America has been very encouraging. We also commissioned our first campus-level manufacturing facility in Pune. Satyendra Singh, our CEO, will delve on this in detail in his comments. During the quarter, we have received major orders in smart meters and expect this segment to contribute significantly to our revenues in this year and coming years. Another significant milestone is that we have received PLI approval for two segments in the medtech business, which is cancer care, radiotherapy devices, and anesthetics and cardiorespiratory devices, including renal care. We believe with this PLI in our hand, it opens up avenues for targeting this business both in India and globally. The business funnel continues to be strong with onboarding of new clients in the power supply, smart metering, fuel dispensing, IoT and auto vertical, and also expanding the portfolio with existing customers. We onboarded 9 new clients in H1, which have a potential of giving 500 plus crores of revenue in the coming year. 5 customers which were onboarded last year or earlier this year have gone into commercial production. I now hand over to Stinda to delve on detail on the expansion plans which we have now initiated at Pune. Over to you, Stinda.
Thank you, Gujaratji, and good morning, everyone. I think as Gujaratji shared, and you might have seen our announcement, so we commissioned our first campus in Pune. This is a shift in our strategy. So far, we have always built the factories which were exactly mapping the requirement from the customers which we saw in the near term. This one is a shift wherein we are investing ahead of time. It's a large campus with 26 acres of land, and our first building with 130,000 square feet has been commissioned. Fills in the gap which we had in our offering so far. Geographically, we have always been very strong in north of India with multiple factories and likewise in south. But in west, we were missing the ability to offer solutions to our customers. So this inauguration has been met with a lot of excitement. We have very positive response from our customers, and we expect this factory to help us increase our revenue and the ability to offer to our customer solutions closer to where they are. So we are definitely looking forward to a growth in this year as well as in next year. This campus, when it's completed, would have the possibility of about 1.2 million square feet space, and that would be done over next years. And to start with, we have put investment of about 100 crore, but we'll keep increasing the investment as we go along. With this, I think I'll turn it over to Vijay to run us through the detailed numbers for the quarter. Over to you, Vijay.
Thank you, Satyendra. Good morning, everyone. I'll now take you through the brief financial performance for the quarter and the half year FY25. Our operating revenue for the half year is 2,003 crores rupees. That grew strongly by 52% on a year-on-year basis. And for the quarter, it is 834 crore rupees with a 17% growth on year-on-year basis. During the half year, the growth has been mainly contributed by a stronger demand growth on the consumer, healthcare and IT railway side. And similarly, during the quarter 2, the strong growth has been supported by auto and industrial sector primarily. This quarter, we had a strong rebound on the margins also, led by expansion into the gross margin on the back of change in product mix, business mix, our continuous effort on the operational efficiency, and also stable overhead costs. Our gross margin for the quarter is about 25% with an expansion of almost 180 bps on year-on-year basis. And for the half year, the gross margin is approximately 20%. Our operating EBITDA for the quarter is 73.8 crore with an operating EBITDA margin of 8.8%, growing 46% year-on-year. For the half year, it is 127 crore with 6.4% of operating EBITDA margin, again with a growth of almost 37% on year-on-year basis. Same way, PBT for the quarter is approximately 49 crore and for the half year, it is 78 crore rupees. Coming to PAT, PAT for the quarter is 38 crores with a PAT margin of 4.5%. And for the half year, it is 60 crore rupees with a PAT margin of 3% for the half year. Coming to order book visibility, we have a very strong open order book as of now, as on September end is approximately 4,800 crores, which comprises almost 24 to 26% of auto sector, 25 to 28% of industrial sector, about 35 to 38% of consumer sector business, and balance is IT and railways. Near about 6 to 8% is healthcare also in this. Coming to our working capital performance, we have been successfully able to bring it down to 56 days of net working capital from a 70 days of net working capital days investment from the start of the year. Again, we target to keep it below 60 days on a sustained basis going forward. Moving to our debt position, we have a gross debt of 603 crore rupees as on September end, September 30th, 24, which includes mainly working capital debt of approximately 500 crores and balance 100 crores of term loan primarily. We continue to hold 423 crores of treasury as on September end, and with this, the net debt position for the quarter end is 180 crores. Our operating cash flow for the half year is 211 crores, largely on back of better working capital efficiencies and better profitability for the half year. Coming to CapEx, during the year we had spent almost 175 odd crore rupees, with a large part of being utilized in readiness of our new campus facility in Pune that was inaugurated last week. With this, we expect large part of our CapEx is already behind us, and again we may incur another 30 to 50 crores in the H2 of this year broadly. Coming to our ROC performance, for the quarter, it is at about 11% when we calculate it after adjusting for unutilized IPO points and goodwill. Regarding our guidance for the full year, financial year FY25, we continue to maintain same guidance as was communicated last quarter also, with a 4,500 crores of revenue target for the full year and again 7% of overall average EBITDA margin. We still continue to focus on working capital efficiencies, operational efficiencies improvement, and deliver on the guidance. With this, we thank you very much, and I'll hand over this call to Ravi just now for the question answer session. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Rahul Gajare from Haitong Securities. Please go ahead.
Yeah, good morning, gentlemen, and congratulations on good performance in this quarter. I have two questions. One of them is a bookkeeping question. You indicated, the capex that you have planned for FY25. Can you talk about the likely capex over the next 2-3 years? What are the things that you have in your mind in terms of expansion?
We have approximately 130 crores of IPO proceeds still unutilized, which we will be spending in next 1.5 year broadly, and this will be going towards furthermore upgrading the Pune facility and also developing our facility there in Hosur, which was planned at the time of IPO.
Okay, so 130 crore over 2 years, 26 and 27. I think that is how we should read this. Okay. So my second question, normally, in this particular quarter, we've seen, consumer has gone down, and industrial has also picked up, healthcare has also picked up. You also typically give breakup in terms of PCB, box build, RFID, share of ODM. Can you give that? And also, since you specifically said exports are expected to see strong growth in the second half, which are the segments that are expected to contribute towards the export growth in H2? Thank you.
Sure. So just to give you a breakup here, RFID plus magnetics for the H1 is approximately 7% of the full year revenue. And same way when we talk about ODM business is almost 11% for the H1. Again, when we say here, considering the seasonality for the H2, we expect better healthcare business and the export business, which will improve the overall ODM and RFID capability or mix in the second half.
And any particular segments that you have in your order book, for export that you want to call out?
In exports, primarily the segments which we service are industrial and healthcare, primarily.
Okay, thank you very much. All the very best. And happy Diwali to you all.
Thank you.
Thank you. The next question is from the line of Girish from Morgan Stanley. Please go ahead.
Yeah. Hi, sir. Sorry if I missed this comment earlier. I just wanted to understand the guidance for this year and next year on revenue and margins.
This year we have guided a growth of about 40-45%, which translates into a top line of about 4,500 crores, with an operating EBITDA of about 310 to 320, which translates into 7% growth. For the coming years, as I had shared in my Q1 earning call, we maintain EBITDAs at 7% and top line growth of 35-40 odd percent. Any positive impact bump in EBITDA in the coming years we'll share with the street after it has been delivered, rather than sort of estimating that it will go up. So we maintain a conservative guidance of 7% EBITDA with a 40 odd percent growth in the revenues, 35, 40, 42% growth in the revenues.
Okay. Just a follow-up in terms of your business mix from exports into next year, and also consumer, as you guided earlier, as a percentage of revenue might come lower. Isn't it natural to assume that at least there will be a 50 basis point margin improvement next year?
See, I think we'll count the chickens when they're hatched. And being on the conservative side, logically what you allude to is a distinct possibility, but we hold our horses at 7%.
Okay. Just final question on exports. Can you help us with where you're getting traction, either new set of customers or which specific segments? If you can call out a few names which can actually improve the export.
I would not be able to call out the names because of confidentiality clauses with the customers, but I can broadly or in detail share with you. We have a very strong traction of exports coming in from Europe, though Europe as a market is seeing a very subdued half year. Europe is not growing. In fact, the major economy of Europe, which is Germany, is almost into a recession. Despite that, we expect our exports to grow this year by about 20%. We did about 100 million last year. I expect on a conservative basis that I should be doing 120 or maybe more of the exports. America, we were not significantly present in the EMS space. What we were exporting to America was RFID. EMS, we have got the toehold. The customer which was onboarded last year has gone into series production as we speak in October, and we expect that this would significantly grow in the coming year. Current year, it could be 40-50 crores against the original estimate of about 65-70 crores. MedTech business is seeing a strong traction across continents. We have won significant contracts from Japan, Europe, and America. And the pipeline looks very, very healthy over there.
So total exports this year, if I can just ask ballpark, would it be like 20% of revenue?
1,000 crores, we said. I had alluded to 1,000 to 1,100 crores.
Okay.
I am very confident that we should be able to cross the 1,000 crore mark. Some of the customers had a delayed takeoff because of new product approvals, but it would be a 20%. If it's a 20% jump, it will be 960, it will be 25, it will be 1,000. So I'm very confident that it should be closer to 1,000, which I think is a very positive commentary on our team's efforts that neither America nor Europe is growing at that rate, and if still we can grow at a very healthy 20-25%, 22% growth rate in these two continents, I think it's a testimony of what we offer, the value we offer to the customers.
And based on the visibility that you have in the pipeline, next year, as you rightly said, you'll probably grow at 35-40%. Fair to assume that exports will be growing in line or ahead of that number for FY26?
See, okay. Our long-term vision is that exports should constitute one-third of our revenues. Now, if the exports have to constitute one-third of our revenues, it is very, very imperative that we at least grow by 20-25%, or maybe in 1 year we have a bump up. But a 20-25% growth in exports in the coming year would be a distinct possibility, and we are planning and aiming for that.
Thank you and best wishes, sir.
Thank you. The next question is from the line of Deepak Krishnan from Kotak Institutional Equities. Please go ahead.
Hi, sir. Am I audible?
Yes.
Yes.
Just wanted to sort of clarify, I think in one of the media interactions you had indicated, potential 12 to 15 crore of PLI incentive booked this quarter. Just wanted to know the actual number, and given that we have sort of booked 4 crore in 1Q, and we had said about 16 crore of, PLI incentives. Are the incentives as such done for the year, or because we have seen strong growth over the last 1 year, the incentive numbers can even be higher?
See, the PLI number, as we had continued to share earlier interactions, also is based on the PLI scheme, approval which we have got with the government, and we believe that it would be around the figure which you have just mentioned for the year. And
So,
this is only the telecom PLI. This is only the telecom PLI. The IT PLI has yet not kicked in, this being the first year. I think closer to the end of this year, we'll be in a better position to share with the street what volumes we expect or don't expect in the IT business and the impact of the PLI in IT. The third PLI which we have got is on the consumer business, which the current volumes do not attract activation of the PLI. So that's currently dormant, approval which we have got. However, as I shared in my opening comments, we have got a PLI approval for MedTech business, which again, like the IT business, we would be in a better position to share with the street the impact of the PLI business, which will be only in 25-26 and not in 24-25.
Sure, sir. So fair to assume that all the PLI sort of booked in one night so far. Maybe just
PLI based on the sales and everything as per the industry practice.
Sure. Maybe just wanted to understand, given the Pune expansion and the 130 crore sort of expansion that we've sort of planned for 2 years ahead, what is sort of the peak revenue potential we can do after all of these capex expansions undertaken?
Okay. You see, for the half year, we have done a revenue of about 2,000 crores. And this is based on a less than 70% capacity utilization without considering Pune, because Pune has been commissioned in October. So whatever plants we had commissioned in September, it was less than 70% average capacity utilization. Now, if we do the back of the hand calculations, the capacity installed till September was good enough for us to cross the 5,000 crore mark. Whatever we invest in Pune would be beyond that. So I think with Pune expansion being in place, we are well, the capacity we have created should enable us to cross the 6,000, 6,500 crore mark. The variation of 400-500 crores would depend upon the product mix.
Sure, sir. Maybe just one final question. Just on industrial, wanted to understand how big is smart metering today in terms of overall revenue potential, and is it a complete domestic opportunity, or do we sort of do substantial exports as well on the smart metering front?
Sorry, I couldn't get the question. Can you repeat it, please?
Just wanted to check on industrial smart meter. How big is that within the industrial revenue? And how much of that is domestic, and how are we also exporting to any countries?
No, for the benefit of the street, we have been present in the energy or utility metering business for the last 19 years, and we are one of the largest contract manufacturers in this space. When I say contract manufacturers, we make it for the energy metering companies. We are also one of the largest players in the smart metering business, and we have got formidable clients. For your consumption, during the first half, we sold 1.3 million smart metering units, the electronics for smart meters, to our customers in India. We have just started the export of utility metering systems or modules to USA. This has started last month, and its series production will go from October onwards. I expect this business in this particular year, the export business from the utility metering business to contribute approximately 35 to 40 crores, 40 crores. Next year, it has an uptake of crossing the 100 crore mark. Domestic utility metering business is strong, and we expect that it will be approximately 250 to 300 crores.
Sure, sir. Those are my questions, and best of luck for future quarters.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address the questions from all the participants, please limit your questions to one per participant. I repeat, please limit your questions to one per participant. Thank you. The next question is from the line of Madhav from Fidelity Investments. Please go ahead.
Hi, good morning. Thank you so much for your time. I just wanted to understand on the PLI. You all mentioned that on the consumer PLI, you said volumes may not lead to us crossing the threshold. Just wanted to understand what's changed there in terms of when we applied for the PLI versus now. Just to understand that. Thank you.
Yeah. This is the consumer PLI is essentially for electronics, which is the indoor, outdoor, and the display units for air conditioning. Till now, bulk of these are being imported, and the threshold limits in that component PLI are capex and the revenues are pretty large. Now, if I make the investment and I'm not able to achieve the additional revenue because I have a certain revenue on the base year, so it has to be the incremental revenue on the base year. Based on the current order profile which we have got, we see that we will not be able to do that incremental revenue. Until we do the incremental revenue, we are not able to get the PLI. Now, if the situation changes in the coming quarters, if we are able to sort of get the business, and there are certain policy initiatives of the government of India, like BSI certification and blah, 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 if they kick in, then the imports would take sort of a negative impact, and it could have a positive rub-off on domestic manufacturing. Currently, the situation is we are not able to cross that threshold delta limit of incremental revenue, and hence we are not eligible. Vijay, you would like to add something?
So that is where we are still working on this consumer PLI piece, and gradually, once we get the desired volume, then only we would be able to claim for it.
But, and on the IT PLI also, if you could explain what kind of opportunity are we targeting, and basically what would sort of guide us to sort of target that PLI?
See, IT PLI, we are still in discussions with some major companies. The products which we are manufacturing thus far do not qualify for the IT PLI. I hope, as I said in my opening statement, we would have clarity maybe closer to the December or March quarter once we are able or not able to tie up with the manufacturer for the products which are for the eligible products. Now, clarity will emerge in the coming months, and hence I will refrain from hazarding a guess on the figures and the quantum. It's still in a nebulous state. We have not been able to tie up for the eligible products with credible ODM partners.
Okay, understood. Okay, thank you.
Thank you. The next question is from the line of Indrajit Agarwal from CLSA. Please go ahead.
Hi, thank you for the opportunity. I have a question on margins. So as we head into the second half, which is a seasonally stronger period, in addition, we will have a much better proportion of exports, somewhere close to 26-27%, if I go by your guidance. And the order book looks more geared towards a higher margin product. So what makes us, from about 8.5-9% margin this quarter, what makes us conservative on the full year margin guidance? Why can't we do, say, closer to the current run rate?
See, we still again hold by the 7% EBITDA margin. We may call it a conservative estimate. We believe that we are currently sitting at about 6.4% or 6.36% margin for the half year. So to achieve the 7%, I will have to achieve 7.5 or 7.52 or 7.6. So whether I achieve 7.6 or 7.8 or whatever, I still hold the guidance which you have given, which is a 7% EBITDA margin for the year. By December, we'll be in a much clearer position whether there is an uptick on it or not. But today, I will hold my horses, as I keep saying, at 7% EBITDA margin.
Sure, this is helpful.
For the full year.
Okay, thank you. And secondly, when we look at the capex from here on, right now, whatever is remaining in Pune and then the IPO proceeds, with that, we could do somewhere close to maybe 6,500 crore. So post that, what kind of asset turn can we look at, say, on the medium term basis?
So on a maintenance capex basis, there is not much of maintenance capex we need to incur. It will not be more than 10 crores that way. But yes, depending upon the new business additions, we may keep on adding few more SMT lines into the currently developed infrastructure. So that way, that will be all incremental linked with the new businesses. On an average basis, we can still consider 50 crore per annum basis.
And that could enable us to grow at 30-35%, at least for the next few years.
That's what we are targeting, yes.
Okay, thank you. That's all from my side.
Thank you. The next question is from the line of Sonali Salgaonkar from Jefferies India. Please go ahead.
Good morning, Mr. Gujral, and congratulations to you and the team. So my question is regarding the consumer business. Now that it has gone down in our overall mix and the industrials has come up, where should we assume the consumer business percentage in the overall mix by FY25 and going forward across in 26-27? And secondly, I might have missed the PLI incentive number that you would have talked about. So what is the PLI incentive expected in FY25? And are you planning to share it back with the brand owners or utilize it for our own growth? Thank you, sir.
Okay. Now, on the consumer mix business, Q2 saw it dipping to 33% and Q1 it was 54%. Based on the orders in hand and deliveries which we have to make, I believe we would be hovering around 40% for FY25. It could be a couple of percentages up or down, but it would be hovering at about 40%, and that's what we had started off the year with a consumer mix of about 40% in our overall basket. The endeavor of the management is to bring it down to below 35 or to bring it down to 1/3. I don't see that happening in the current year. It could be a possibility going forward next year. So this year we should hold it at about 40-odd%. On the PLI, we have different arrangements with different customers on sharing, and whatever figures we share are what comes to us, not the gross figures. The gross figures could be much higher, but what affects my P&L is what we share with the street.
So we only consider net basis.
Net basis. Whatever has to be passed through, we don't consider that.
Sure, sir. So on a net basis, what is the kind of PLI incentive you expect in FY25, and it will mainly come from telecom and IT businesses?
We expect around 15 odd crores, and it will primarily from telecom. I don't personally foresee any amount coming in from IT. If it comes, it will be very, very small. I don't see a IT PLI kicking in FY24-25.
Very clear, sir. Thank you, and best wishes for the festive season to you and the team. Thank you.
Same to you and your team.
Thank you. The next question is from the line of Sumant Kumar from Motilal Oswal Financial Services. Please go ahead.
Hi, sir. So in last 5 quarters, we have seen a significant growth on the top line side ranging from 38 to 90%. But margin was under pressure. And this quarter we have seen we have a 17-18% kind of growth, but margin is better. So going forward, what is our strategy? So have a decent margin with decent growth, or higher growth with maybe compromising on margin? So what is our key strategy going forward to for the earning growth going ahead?
See, the past quarters till FY24, the margins were so good because we didn't have a high volume consumer business in the preceding years, which were kicked in last year, and there was a very high capex cycle and expansion, which led to an increase in the overheads. Going forward, as we have indicated for this year, we're very confident of growing at 35, 40, 45% and maintaining EBITDA at about 7%. This would largely be driven by growth in my exports, my medtech business growth, my industrial growth. So overall, it's not that we sacrifice one segment for the other segment. It is a customer need which has to be satisfied. And if a high volume consumer customer has a high need, I, as an entrepreneur, would not say no just because it depresses my margins. But the portfolio mix which we have, we are very confident of delivering the 7% EBITDA margin this year and going forward next year also.
Okay, thank you.
Thank you. The next question is from the line of Praveen Sahai from Prabhudas Lilladher, India. Please go ahead. Mr. Praveen, your line has been unmuted. Please go ahead with your question.
Yeah, sorry. Hi, thank you for opportunity. So my question is related to the export. As you had mentioned that the second half expected to be around 35% of a growth, like by calculating what the numbers you had given. So if you can give some highlight on the order book, how much of the export order book you have, and also on the segment wise would be helpful. Thank you.
As I had mentioned earlier in one of the earlier questions, our exports are primarily into the industrial and medtech segment apart from RFID. So these 3 verticals constitute the backbone of our export revenues. Industrial, which would include utility metering, which would include power supply management, which would include industrial cleaning, which would include renewable energy, solar, products related to solar, and box build for other applications, apart from medtech devices and RFID. The growth which we are projecting for the current year is based on the orders or the visibility which we have from the customers. So when I say our exports would go up by about 20-25% to about 1,000 crore rupees, which is a delta of about 200 crore rupees over last year, it is based on the orders and the visibility and the agreements which we have with our customers.
So 4,800 odd crore of order book, how much is the export order?
Broadly around 22 to 25% would be export in this thing.
See, if my export is about 25% of my revenues, with order book by and large, on an annualized basis, would have that percentage. Quarter on quarter could be marginal variances. So if I'm committing 1,000 crore revenue, I'm committing it based on the orders which I have in hand for execution in this year. And Vijay has shared the figures with you.
Right, sir. Anything on the Johari, how much in the first half the revenue you have done?
Johari, it typically takes off in the second quarter and third and fourth quarter. Second half for medtech business is typically much higher revenues and margins. The first half is comparatively subdued as per the previous year experiences.
Okay, thank you, sir.
Thank you. The next question is from the line of Keyur Pandya from ICICI Prudential Life Insurance. Please go ahead.
Thank you. First question is on the asset turn side. So what would be our gross block, say, X of Pune and including Pune? And do you think our revenue, fixed asset turn potential has gone up? I think earlier you have talked about anywhere around 4.5x kind of gross block asset turn. So where do we stand on that number, gross block and asset turn? And second is, for last couple of quarters, we are seeing payable days significantly higher than what it used to be earlier. So is there a change in policy? Should we consider it more of steady state number, or there is some tactical call that we have taken to have lower payables?
So my asset terms currently are in the range of around 5.5 times. And when we talk about gross block, it is about 800 crore plus, which includes Pune number also, Pune facility, maybe about 100 odd crore rupees. And maybe few other Manesar expansion and all other CWIPs are including in this thing. So broadly, those assets or maybe those CWIPs may result into final profitability next over 2 years. And once we achieve that thing, I think we should be able to achieve a 6.5 times plus kind of a asset turn on an average basis.
And on payables? Higher payable days?
Payable days. Yes, that is primarily depending upon the business mix. There are different businesses which we do. So just like consumer business, when we talk about, consumer business has a different payable and different industry or maybe inventory matrix. That's how it is based on the business mix there. As of now, it is around 100 days plus of payable days, and we considering if we like full year also, we will be doing around 40% of a consumer business, and the payable days will be exactly almost similar in the similar range going forward.
Okay, noted. Thanks a lot. All the best. Happy Diwali.
Thank you. The next question is from the line of Parth Gala from HDFC Securities. Please go ahead.
Hi, gentlemen. Good morning. Just one question on the material margins. So for the past couple of quarters, consumer business, the material margins were hovering in single digits, probably high single digits. But is there any change in this quarter? Because, the sense I'm getting is that it's gone back to a double-digit kind of a trajectory. If you can share some more light on this, that would be great.
See, as I have been sharing all along, what we monitor is the margin profile of each vertical, and there we don't see any depreciation or decline. The high volume consumer business, the consumer business is split into two. The high volume consumer business, which is the backbone and bulk of the consumer segment, and then it's the low volume ODM, other consumer business, which is in line with my other verticals in terms of margin. We have not seen any accretion of margins in the high volume consumer business, and they continue to hover with the figures which we had said was less than 10%, 9%, 10% gross material margin. We have not seen any depreciation nor any accretion in this segment. Other segments have seen a small positive uptake, which has been because of better buying, better negotiation, better realization from customers, and better product mix.
Understood, sir. So would that mean that the second quarter had a higher share of the low volume ODM business in consumer? And what would the mix stand, if you can, for the second half as well?
See, for the Q2, my consumer as an overall basket came down from 54 to 33%. And this decline was primarily driven by the high volume, low margin consumer business. The low to medium volume, normalized margin consumer business grew at its normal pace which it was there. Going forward, this year, we believe that our consumer business would constitute approximately around 40% of our revenues. And this is what we had factored in our annual plans, which we had shared with the street when we said that we'll be doing about 4,500 odd crores of revenue and 310 to 320, in fact 315 to be precise, EBITDA numbers. Now, if going forward in the next 6 months also my consumer business does not go to 40%, it hovers down, then it will have a positive impact on the EBITDA. But based on the orders and the delivery commitments which our customers are asking, we believe it will be around 40% only.
This is very helpful. Thank you very much and best wishes for the festive season.
Thank you.
Thank you. The next question is from the line of Hardik Rawat from IIFL Securities. Please go ahead.
Thanks for the opportunity and congratulations on a good set of numbers. The question that I wanted to ask was with regards to our margin expectation in the second half. Now, going by the guidance, second half should see an uptick in both exports and medical revenues. So, what could be some realistic reasons as to why margins should dip in second half versus the first half? For the first half, we are looking at EBITDA margin blended of about 6.4%, and the second quarter we ended at 8.9%. So largely not from a blended 2H perspective, but from this 8.9%, why should the margins in second half, be materially lower than this? Because our current guidance of about 7%.
Okay, we achieved 6.4% for the first half year. Quarter two, with the high volume consumer business at 33%, we touched 8.8, 8.9%. We believe that for the second half, with consumer bouncing back to about 40% of all my revenues, I should be comfortable at about 7.5, 7.6% EBITDA margin, which will enable me to give 7% blended margin for the year as a whole. Now, whether this 7.5 goes to 7.7, I think we are not doing that hair splitting right now. We'll share the results once they are, or we count the chickens when they're hatched, as they keep saying. But we're very confident of achieving the 7%. Any uptake on that, I think we'll share with the street once it happens rather than hazarding a guess in advance.
Yeah, we understand that you're being conservative with the guidance, but like you mentioned in the TV interview that you were there, so this 7% margin expectation is the lower end of our expectations, correct?
That we said that we hold 7% this year. It's the bare minimum which we have to deliver. Anything above that, I think we should hold, have the patience to see when the results are out.
It makes sense. That helps. Another thing was with regards to the PLI figure that you gave out. You mentioned this 15 crore rupees of PLI as cumulative PLI for first half?
This is the accrual PLI for the sales done during the period and expected to be done during the year.
So expectation is 15 crore rupees of PLI in FY25.
Approximately thereabout, yes.
Approximately, correct. Oh, okay, those are largely my questions. Thank you so much.
Thank you.
Thank you. The next question is from the line of Vipraw Srivastava from Phillip Capital. Please go ahead. Mr. Vipraw, your line has been unmuted. Please go ahead with your question. Due to no response from the current participant, we'll take our next question from the line of Saumil Shah from Pras Investments. Please go ahead.
Hi, thanks for the opportunity. My question is on the CapEx side. You just mentioned that we'll be doing 130 crores of CapEx for the next 2 years. And as we are growing at a 35-40% CAGR growth, so back of the envelope calculation by FY27, we should be reaching about 8,000 crores of revenue approx. So will this CapEx be enough to generate that revenue?
Again, apart from that 130-150 crore, we also mentioned depending upon the incremental business, wherever we need to stuff more SMT lines, we'll keep on doing it. So once we reach that 8,500 crores of revenue, if there is any additional plant and machine related CapEx would be required, we will be incurring that thing. So maybe 150 to 200 crore would be required to reach to that level in a way, broadly.
See, again, whatever we have achieved till this half year, it is, as I shared earlier, we're at about less than 70% capacity utilization. Now, if the capacity which I have installed till September of 2024, which will not include Pune, that itself, if it was typically working at 90-95%, would give me a revenue of closer to 5,000 crores. So Pune is in addition to that, and with the figures which Bijay has mentioned, I think we are on track to achieve the figure which you mentioned for FY27. And a lot of it will also depend upon the product mix, how much is a box build, because a box build has a lower capex. It's a very high asset turnover ratio than plain vanilla PCB board, because the major capex goes into the PCB assembly, not in the box build. So as we move forward and the product mix changes, I think with the figures which Bijay has shared, we are on well track to achieve the long-term objectives of the company.
So you just mentioned 130, yes. So you just mentioned 130 to 150 crores of capex, no, Vijay?
Yeah, that's right. That is from the balance IPO proceeds, and beyond that, we may have to fund from internal accruals. So broadly, 150 to 200 crore is what we are saying in total.
So on a higher side, next 2 years, 200 crore capex on a higher side.
Yes.
Okay. That's it from my side. Thank you and all the best.
Thank you. Ladies and gentlemen, we'll take this as the last question. I would now like to hand the conference over to Mr. Gujral for closing comments.
At the outset, thank you very much for all of you for participating in the call during the festive season. We at Syrma SGS, as I'm all the time been saying in my closing remarks, are very focused on building an institution which is sustainable, profitable, and takes care the interests of all the stakeholders, investors being the most important, but there are other stakeholders as well. We have expanded our capacities, we have expanded our footprint, geographical footprint, and we have also expanded our marketing presence over the last 2 quarters by having dedicated sales teams in USA, which till now are being serviced from India. In addition, the medtech business continues to be a strong driver, and we have entered into new services which are quality assurance, regulatory approval services, which in the long run, I think will form a significant portion of our revenue streams, at least from the EBITDA margins. the pipeline of orders from existing customers and the dialogue with the new customers continues to be healthy, and we are exploring other areas for growth. Overall, the management is very, very confident that we are on track to building a 1 billion organization in the next few years. Thank you very much for the support and wish you all a very happy Diwali to all of you and your families. Thank you.
Thank you. On behalf of DAM Capital Advisors Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.